Welcome to K-Zone. Today, we will share about what happens if the United States, USA, stops loan payments. Let's start. If the United States were to stop paying its loans, it would have significant and far-reaching consequences on both the U.S. economy and the global financial system. Such a scenario, often referred to as a sovereign default, is a highly unlikely and undesirable event. Nonetheless, it is essential to understand the potential consequences of such a situation. Here is a comprehensive overview of what could happen if the USA stopped paying its loans. Immediate financial market turmoil. The announcement of a U.S. default would likely trigger a massive sell-off in financial markets worldwide, leading to a sharp decline in stock prices and a flight to safe haven assets like gold and government bonds from other countries. Interest rate spike. U.S. Treasury securities are considered among the safest assets globally. A default would erode this perception, leading to an increase in interest rates. This would have a cascading effect, impacting borrowing costs for consumers, businesses, and the government itself. Global economic impact. The U.S. economy is the largest in the world, and any significant disruption to it would have a global impact. Reduced consumer and business spending in the U.S. could lead to a global economic slowdown, affecting trade partners and emerging markets. Dollar depreciation. The value of the U.S. dollar could plummet as investors lose confidence in its stability. A weaker dollar would make imported goods more expensive for American consumers and could fuel inflation. Financial system instability. Banks and financial institutions around the world hold significant quantities of U.S. Treasury securities as part of their capital reserves. A U.S. default could severely weaken the balance sheets of these institutions, leading to a financial crisis reminiscent of the 2008 global financial meltdown. Credit downgrades. Credit rating agencies would likely downgrade the U.S. credit rating, further increasing borrowing costs. This would not only affect the government but also American businesses and consumers who rely on credit for various purposes. Loss of trust and confidence. The U.S. has long been considered a pillar of financial stability and trustworthiness. A default would severely damage its reputation, potentially leading to a long-lasting loss of trust among investors and foreign governments. Political and social consequences. A sovereign default could lead to political instability and social unrest within the U.S. as citizens face reduced government services, potentially including cuts to entitlement programs, infrastructure projects, and public services. Global financial institutions exposure. Many global financial institutions, including central banks, pension funds, and private investors, hold U.S. government debt as a core component of their portfolios. A default would lead to significant financial losses for these entities. Long-term economic consequences. Recovering from a sovereign default would be a prolonged and challenging process. The government's borrowing costs would remain elevated for an extended period, hindering its ability to invest in infrastructure, education, and other critical areas. Potential legal battles. A U.S. default could lead to legal battles as creditors seek to recover their investments. This could result in lengthy court proceedings and diplomatic tensions. International confidence in the dollar. The U.S. dollar is the world's primary reserve currency. A default could lead to countries diversifying away from the dollar, seeking alternatives like the euro, Chinese yuan, or cryptocurrencies. This could weaken the dollar's status as the global reserve currency over time. Geopolitical ramifications. a U.S. default could have significant geopolitical consequences, as it could undermine American influence on the world stage. It might also lead to shifts in global alliances and diplomatic relationships. In summary, a scenario where the United States stops paying its loans is highly improbable and would have severe and wide-ranging consequences. The U.S. government and policymakers have a strong incentive to ensure the country's financial obligations are met to maintain economic stability and global confidence in the U.S. financial system. However, it is essential to be aware of the potential fallout from such a situation to appreciate the importance of responsible fiscal and economic management. Thanks for watching. Don't forget like, share and subscribe.